everybody. Great to see such broad interest from both the Swedish CFA Society and our Nordic sister CFA societies. Welcome, everyone. My name is Christian Guggenheim, and I'm part of the CFA Society Sweden's board and chairing the Advocacy and Membership Value Committee. Today, we're delighted to present an exclusive webinar on the valuation of crypto assets delivered by Olivier Fines and Urav Soni from the CFA Institute. And during the presentation, please interrupt and ask questions as we go along to make the webinar as interactive as possible, either via audio directly, because you have that possibility, or if you prefer, you can write on the chat and we'll take it from there. The webinar will also be recorded and put up on CFA Sweden's homepage, so you can watch on demand later on, or spread it to colleagues that might be interested in the topic. All right, Oliver Fines is Head of Advocacy and Capital Markets Policy Research for EMEA at the CFA Institute. With teams based in London and Brussels, he leads the effort in researching and commentating on the major trends that affect the investment management industry and changes to the professional and policy and regulation developments. The positions taken on these issues and the published research pieces are meant to promote the fundamental principles upheld by the CFA Institute, and that of investor protection, professional ethics, and market integrity. Mr. Fines joined the CFA Institute in March 2019 after a 15-year career in investment management, spanning research, portfolio management, product management, and regulatory compliance work at firms based in Paris and London. Before joining CFA Institute, he was head of risk and compliance at Rothschild & Company in London for the private equity and private debt division. Urav Soni is currently an affiliate of the Research Policy Center at CFA Institute. He graduated from Johns Hopkins University with a Master of Science degree in Applied Economics and a Bachelor of Arts degree in Politics and Economics from the University of Reading in the United Kingdom. All right, so with that, I hand over to Oliver and Urav. Thank you, everybody, for joining, and please ask questions as we go along. Thank you.
Thank you, Christian, and welcome all to this webinar. Urav and myself are thrilled to be amongst your group to discuss crypto assets, and in particular the issue of valuation. I would like to thank again the societies involved, because without societies, our connection to the real world of finance and business would be much more impractical. So we need that connection with professionals in order to discuss these ideas and test our theories. So welcome again, and thank you very much all for participating. So as Christian explained, my role at CFA Institute is to conduct research on the main developments that are affecting capital markets in general, but investment management in particular. And once we've researched those developments, we try to turn them into policy positions, as we call them. The broader term for that activity is what we call advocacy. And one of those developments concerned digital finance. And I'm going to spend a little bit of time on explaining the genesis for this work, at which point I will pass it on to Urav, who will take you through a presentation of what his research on valuation methods has been published in a recent paper looking at those methods and how to apply data in order to get to some valuation depending on the nature of the crypto or digital instrument. Digital finance has caused quite a bit of conundrum for CFA Institute. We are at heart a reasonably conservative organization, and we do not necessarily consider that every single development that we see is necessarily of a structural nature. The problem that we've had with digital finance at the onset was that, contrary to most developments in the world of finance, this one was a bottom-up development from the grassroots of individuals, technologists, and basically individuals all over the world developing products and processes outside of the institutional typical top-down process of developing strategies and instruments and then passed on to consumers. So this grassroots development caused an issue both for institutions like us, but also for regulators. How should we understand this development, since we do not necessarily have the existing institutional relays to properly understand the seriousness and pervasiveness of such a development? So it took us a while to get properly interested in the matter, or to consider it seriously enough. We started fairly late, probably about 3 or 4 years ago at most. Our first piece of research done with an external specialist looking at the development of digital finance. But our first piece of original research at Institute was published actually last year. And we thought, all right, there's no point in either demonizing and essentially denying the existence of digital finance. And at the same time, we did not want to be in the camp of those who call themselves enthusiasts, right? So the trick for Institute was to find just the right balance in describing this development from an investor perspective and exploring the issues that digital finance represents, again, through the eyes of a reasonable investor. And in our first piece, we came up with a series of issues and problems that we then determined we would look into in more details in subsequent pieces, right? One of those problems was to look at crypto and digital finance from a fiduciary perspective. And essentially, if we're struggling to determine how you measure risk or expected returns in this field, and how can you integrate it properly into a portfolio according to typical strategic asset allocation principles, for example. The other problem concerned custody and safekeeping of client assets. We all know of the FTX debacle, and in fact, we had finished our piece just before FTX went under. But we continue to think that the notion of safekeeping of client assets remains absolutely crucial if digital finance wants to be taken seriously. The third problem that we had uncovered in our mind was the issue of valuation. How do you value those processes or assets if you cannot really rely, at least at the time that we were writing this, on existing financial metrics such as cash flows or revenue or financial balance sheet assets? So these problems, we said it's very early on in this development of digital finance, and we will look into those issues one after the other. We then released specific pieces on central bank digital currencies, right? So if you think of digital finance as a coin, you've got a private coin and you've got a public side to that same coin. And central bank digital currencies are potentially the public response to the development of private cryptocurrencies. We then released a piece that is going to be the subject of today's webinar with Urav, focusing specifically on valuation methods and how you can look at tokens and digital finance processes using existing techniques or integrating new methods or new metrics. And in the meantime, we're also continuing to work on the subject, this time looking at tokenization, which is also led by Urav, and which we will release in the future, looking at the processes to tokenize real-world assets and the policy implications. So as you can see, we tried to approach digital finance in as reasonable a way as possible. I will not also lie to you. We have been criticized from both sides of the equation, but I think a crowd like we have today on this webinar is perfect to have an engaging discussion on those valuation methods. We can only assume that some of you are already dealing with crypto assets or digital finance processes. And so we would very much like that conversation to be as dynamic as possible. If you have questions, as Christian said, please use either the Q&A or chat feature, or just raise your hand, for example, and we will try and address your question. For the benefit of those who may not be CFA charter holders on the call, I'll remind everyone that CFA Institute is a nonprofit organization representing about 200,000 members who all have, to an extent, an association with either a society or the global organization, or are CFA charter holders around the world. And so the fact that we are representing our members means our point of view is very much independent of the need to support a particular industry or particular corporation. So I will stop here, pass it over to Urav. And again, please ask your questions along the way. We will be very happy to address your questions. Thank you again very much for being present.
Thank you, Olivier. Let me just share my screen. Yeah, so as Olivier mentioned that we've been looking at valuation, we looked at valuation, and the three main kind of asset types we focused on were smart contract platforms, decentralized applications, and cryptocurrencies themselves. And mainly we focused on Bitcoin within the cryptocurrency category, because obviously that has the most history and obviously is very popular. So smart contract platforms are basically the base layer on top of which decentralized applications are constructed or developed. Examples include Ethereum, Solana, Stellar, Polygon, Cosmos, and then there are decentralized applications such as Uniswap, which is a decentralized exchange, SushiSwap, another one. And so we have various kind of different financial or maybe even other services which are developed on top of these smart contract platforms. So you can think of it as the smart contract platform being like the IT infrastructure, and on top of that, so goods and services are provided to like on the decentralized side of the internet. So yeah, the issue of valuation was mainly coming from, the main question is, should crypto assets be even valued, or like do they even have any value proposition? And obviously that debate is ongoing. It has people on both sides of it. But we wanted to check into the current methods that have been developed and see if there are any limitations to them, if there are any benefits to them. And so the issue that we identified was that there's a lack of historical data. So obviously, if you look at equities, valuation models for them have been developed over maybe the last 100 years, whereas Bitcoin, which was only launched in 2019, or Ethereum was only launched in 2014. So that only gives us maybe 10 to 15 years of data as such to look at. And then obviously, crypto assets are very different from traditional assets in terms of not providing cash flows or how they work. And so that also kind of separates them from the traditional methods and requires more kind of crypto specific models to for people to come up with to measure them. Yeah, and so why we did this was, as Olivier mentioned, we previously published a report. It's called Cryptoassets Beyond the Hype, and we kind of considered that if someone wanted to invest in crypto assets, they had to have value, or a value like a portfolio construction, or even for like including them in their including them in the portfolios, they would have to have, they should be able to provide some sort of reasoning behind why they're including it in the portfolio. And so these are the 4 recommendations that were included in that paper. I'm not going to read through all of them, but basically we don't want people to invest in crypto just because of the hype behind it. And obviously we should be able to look at it from a technical perspective to understand it and then make a decision based off of that. So yeah, we interviewed about 5 interviewees, and these are the kind of the main takeaways we got from them. They're kind of involved in the industry. So one was obviously that Bitcoin remains the most popular crypto asset, followed by Ethereum in terms of portfolio exposure. And the main reason for that is actually because of the market capitalization and the liquidity provided because of that. Again, as I mentioned, the lack of historical data, which is a big inhibitor to construct valuation frameworks. The target portfolio allocation for ranges between 2.5 to 5%, with 5% being after that, the amount of risk you're taking does not kind of like the return you're getting for the amount of risk you're taking is not enough. So like that kind of the amount of risk you're taking kind of goes beyond the return you're getting. And then anything below 1.5 would be too less for the additional risk you're taking by investing in crypto assets in your portfolio. For decentralized applications, we are able to kind of apply traditional valuation methods, something like relative valuation or intrinsic valuation through a DCF model. And the same applies to smart contract platforms. And for smart contract platforms, there are two kind of ideologies behind it. One is viewing them as networks, and one is as a cash flow asset. So that would mean that someone on the end, someone on the opinion that if they have the opinion that a smart contract platform is a network, they wouldn't want transaction fees on the network because that kind of inhibits the growth of that platform. Whereas if someone is viewing it as a cash flow network, cash flow asset, then they would want transaction fees to be as high as possible without obviously diminishing growth, but so that you can see those actual cash flows coming in to the network. And then of course, Bitcoin is, we cannot really apply these models to Bitcoin. And so for that, we considered 4 different models: the total addressable market approach, the stock to flow model, and then the Metcalfe's law, and what's the last one? Sorry, Metcalfe's law, and sorry. Let me come to that. Sorry, I kind of the cost of production model. Yeah. So yeah, again, we can apply the Metcalfe's law to Ethereum or Bitcoin. And then relative valuation includes, they're kind of similar to the PE ratio or PS ratio you would apply in traditional equities. But here you kind of take crypto specific numbers such as the price to fees or the market cap to net assets ratio. And yeah, so we'll start with smart contract platforms. As I mentioned, that there's 2 different views on them. And so as a cash flow asset, income is generated through selling block space, and cash flows are generated by charging transaction fees. So all activity like even if you're sending, let's say, Ethereum to your friend, or maybe buying an NFT, requires a fee to be paid to the network for that transaction to be conducted. And so because of that, we consider transaction fees as cash flows, and we can adapt a DCF model to kind of derive the present value of the cash flows and subsequently like the price of the native asset. And then obviously that's very sensitive to the assumptions that we make as an analyst. And also because there's a lack of historical data, the numbers are very volatile. So we have to keep all that in mind when we are looking at it. And then on the other hand, we're looking at smart contract platforms as a network where you would use a qualitative framework or a Metcalfe's law, which kind of looks at the number of active addresses or the number of users on the network to kind of get a value for the smart contract platform. So yeah, the first DCF model that we kind of made was for Ethereum, and we did a 5-year forecast with we based the growth assumptions on the aggregate growth rate over the last 3 years, and we assumed that the growth rate would decrease by 10% each year because the system would at some point slowly reach maturity, and we kind of compared smart contract platforms to a small cap software sector firm, and so we kind of took an average of the 35 small cap for the EV/EBITDA average for those 35 firms to get the terminal exit multiple. The cash flows are kind of the transaction fee plus all the new Ethereum which is issued into existence every year. And the transaction fee can be broken down into a base fee and a priority fee. So the base fee is burned. Burned means that it's sent to an address which no one has access to, and so no one can ever use it again. And the priority fee is given to the validator for validating the transaction. So over here, you could possibly come up with a few different types of like if you're assuming that so there's the idea that the burning the base fee is similar to like a share buyback. So we could possibly include that or not include that in your analysis. We did include it for ours. And so we have for 2022 the transaction fees were 2.441 billion USD, and the yearly issuance can be calculated by doing 1700 is the estimated per day, 1700 times 365, and then we took the average price of Ethereum for that year. And of course, as I mentioned, the limitations are that the volatile historical figures, and then the industry itself is very nascent, which makes the model very sensitive. So even a few changes in the growth rate assumption actually leads to big changes in the final price that we get. Yeah, and obviously there are other approaches to the model that you could take. You could go for a perpetual growth model instead of a terminal exit. And obviously you could apply something else instead of EV over EBITDA to the terminal exit multiple. Yeah, and obviously, as I mentioned, you can remove the theoretical increase in the base fee, which is burned, the share buyback, and just include the priority fee and the issuance as actual cash flows. So there are some people who might consider that as the cash flows, and there are some who might consider all of them. So that depends on the analyst again. So yeah, this is the model that we kind of made. It's a very simple model. But as I mentioned, we started with the 56.99 is the 3-year aggregate growth rate, and then decrease that by 10% each year. And based on that, we the 22.4 is obviously the EV EBITDA average of the 35 small cap software firms. And based on that, we get a price per Ethereum of 2051. Obviously, that is much lower than the current prices today. And so you could say that Ethereum is overvalued if this model was, correct, assuming that the model is correct. And yeah, sorry. Then we go into the network like the qualitative framework, which is kind of comparing the demand side metrics through various ratios. And so total value locked is the amount of the number of tokens that are locked across all decentralized applications on a smart contract platform. So for example, on Ethereum, 21.39 billion is the total amount locked as of September 2023. And so we can compare it on a numbers basis, basically saying that, oh, okay, Ethereum has the highest amount of TVL, and it has also the highest amount of fees again. So, but the point here is that it's a very qualitative way of looking at it, and it's fairly kind of dependent on the assumptions that you're making. So I could also say that BNB chain has the highest amount of active addresses on a daily average. So that is the numbers are not going to speak for one smart contract platform itself. You could possibly do a comparison between Solana and Cardano, which have kind of similar numbers, and then kind of do a relative valuation, like looking at both. If you're looking at, if you want to invest in one of these, which one you could possibly look at, look at these numbers and kind of compare and decide, make your own decisions. Yeah, and then of course you go into the tokenomics of each platform, which are different. So the maximum supply is not applicable for these two, Ethereum and Solana, because they don't have a limit to how much you can possibly produce. That's completely based on demand and supply for those two networks. The other three have a kind of a maximum limit, after which there's not going to be any possible token being issued into existence. And then we have inflation of that token. So inflation is kind of good and bad in this sense that you need to produce more, like you need to make more tokens to reward validators for the security of the platform. But obviously you don't want it to be too high to like kind of, devalue the currency, devalue the platform itself or the token itself. And then the third part is the private token allocation, which is kind of how much of the token is allocated to insiders or maybe a VC firm which initially invested into the platform being developed. So that issue comes up when if something like a VC firm wants to exit their position and they kind of dump all of the tokens into the market, the price is gonna can obviously fall because there's an excess supply in the market of that token. And so sometimes, usually what happens is that these platforms negotiate with that firm saying that your exit is kind of staggered over a few years so that there's not going to be a big impact on the price of the token. But that is something we should be looking at also when considering it from a qualitative framework. And then the staking APR again is when you have staked your assets into a network, how much of a return are you getting, the yield you're getting on that. And obviously that shouldn't be too high again, because you're minting more and more tokens to give out that APR, and that's kind of devaluing the currency, the token. So then scalability is, okay, if a platform is currently, let's say, managing 11.16 transactions per second, how much more could it potentially take up? How many more transactions could it take up in its network before kind of slowing down or, leading to other issues? So yeah, as you can see, Ethereum is actually very close to its maximum transaction per second. And you do see that the fees are very high on Ethereum when there's periods of high demand. And so to kind of solve that, they've been developing a lot of layer 2 solutions, which kind of allow Ethereum to scale more than compared to its current capacity. And again, there's Solana and Avalanche, which have kind of the highest possible transactions per second it could potentially take. These are, of course, theoretical values. The actual TPS hasn't reached that amount yet. So when it does come, it will test the network at that point in time if those many transactions take place on the network. And obviously, again, the transaction fee. You can see that Solana, Cardano, kind of they have very low transaction fee. So you could think of it in a way that these platforms are the ones where someone would like to transact or make more decentralized applications because the transaction fees are so low compared to something like Ethereum. So now we come to Metcalfe's law, which is developed by it was first initially used to kind of measure the growth of social media platforms like Facebook and Tencent. And it did fit the model. The amount of users on Facebook, kind of the Metcalfe's law showed that it did fit to the model. And so basically it's calculated as the value of a network is equal to the square of the number of its nodes or users in the network. So this is like the basic equation, V is equal to N squared. Now, obviously, there are iterations to this. We just use this to simplify it and kind of make it understandable. And there's obviously disagreement over the square number. So some people say that it's 1.69, which could better fit crypto assets. And then there's others which is maybe kind of even lower than that. And so we can't know the number of users on a crypto asset on any smart contract platform. So we kind of use active addresses as the proxy for that number. And so yeah, this figure here shows the kind of it shows the 30-day moving average of comparing the market cap and the network value according to Metcalfe's law. So you can possibly see that from this you can kind of see that the market cap has been lower than the value of the network according to Metcalfe's law over the probably from 2017 to up until 2020, 2021. And then we saw that kind of bull market in that 2021, 2022 year where most crypto assets had like run up a lot in the price, and that's when it kind of crosses the value of the network, because the number of active addresses on a daily basis could be the same, but the price went up so much more that like the network value remains the same, but you could say it's kind of overvalued relative to the network value according to Metcalfe's law. And then obviously again, now we have seen over the past few months that Ethereum has been rising again, and it kind of crossed the network value according to Metcalfe's law, and has been above that for the last maybe kind of 1 year. Yeah. And then we switch to decentralized applications. We start with relative valuation, where we look at ratios such as price to sales, price to fees, and then market cap to total value locked on the network. And we kind of use 3 decentralized exchanges to make that comparison. So Curve, Uniswap, and Balancer, all 3 of them are built on the Ethereum network. So it's kind of, we kind of pose the question, if we had to invest in maybe a decentralized exchange on Ethereum, we could probably compare these 3. And what we can do is basically use the numbers that we have for the past year and then calculate the ratio. So TVL ratio would be just the market cap divided by TVL, and similarly price to sales and price to fees. And then we can calculate the price of maybe Curve at the TVL ratio of Uniswap. So that at that point in time, the price of Curve was 0.45, but at Uniswap's multiple, it was 2.86. So you could say that it was undervalued relative to Uniswap. But finding out the reason why it is the most important factor. There might be an opportunity where like you can say, oh, it is actually undervalued and it's not being priced properly. But then usually there are reasons, or maybe most of the time there are reasons why that kind of number is lower than a competitor's multiple. And also sometimes what we've also noticed in some of the papers that I read was that you could probably use this to compare it with traditional exchanges. So for example, you could there have been examples of where these have been compared to like the New York Stock Exchange or the London Stock Exchange, to kind of see where it compares to a traditional financial company. And then we use a DCF model for Balancer. And then again, same 5-year projected growth rate for decentralized exchanges. And we kind of expected that it would maintain a 4% share over the next 5 years of the total transaction volume of the decentralized exchange market. We used a 30% discount rate because we compared it to a startup. And usually they warrant something between 30 to 70%. We used the lower end of it. And we calculated a fee. So the fee is not fixed on balance, so it kind of ranges between 0.01, 1%, and then sometimes even it usually goes about 1.5 or maybe 2%, but usually it's between this range. And we calculated based on that. Yeah. So based on that, we got a kind of the fee as 0.0397. That was the kind of volume weighted average on the platform. And we took the total decentralized exchange volume and took 4% of that, expecting that the decentralized exchange market grows by 81% and then cuts down by 1.5, I think. Sorry, 2.5 each year. And we, as I said, we assumed that 4% would be the market share. And based on that, again, we got a price of 5.32, which was relative to, at that point in time, Balancer was undervalued. Yeah. And then finally, we have Bitcoin, which obviously is the most popular and most traded crypto asset with 46% of total market capitalization. It's crossed 50 right now, I think this month, of the total market capitalization of the crypto asset market. And so the first one we considered was a total addressable market approach, which was you compare it to other assets such as gold, central bank reserves, global remittances, M2 money supply. And we kind of took it was a very simple equation that we had, which was the level of penetration times the value of target market, and then divided by the fully diluted circulating supply, so which is 21 million. That's the amount of Bitcoin which could ever exist. So this kind of depends on what you look. So the most compared asset to Bitcoin is obviously gold, and maybe after that global remittances, where if that is a use case of or a medium of exchange, if Bitcoin is used as a medium of exchange. So we kind of got this table, which was at what percentage of at various percentages of the penetration, what would be the value of Bitcoin, depending on the market value of other kind of assets or like markets, things, of course.
And so, Urav, can you spend a little bit more time on this slide there? What's your conclusion from
yeah?
Can you explain? So M2, it's the money supply, and can you, because this slide is interesting in order to compare.
Yeah. So we consider that gold and remittances to be kind of the most plausible explanations for an addressable market for Bitcoin. Gold, the most, I think, plausible one, because we have seen it being used as more of a store of value compared to a medium of exchange. But then we also have to assume that Bitcoin is taking gold's place in portfolios as a store of value, which we cannot prove, obviously. So, and obviously it does not compare to, like, let's say another Bitcoin somehow comes up in the future, like, or is currently some other currency is considered as a store of value. That it doesn't account for that competition yet as well. Sorry. So yeah, again, if it's simple as that, if at 5% penetration, at of gold's value, it would be something around 30% or 30,000, sorry, 31,000 of that would be the price of Bitcoin, and we are assuming fully diluted supply, not the current circulating supply. And so, similarly, sorry.
If I'm correct, at the moment, Bitcoin is around $65,000 per coin.
Yeah.
So if I look here at gold, it would require a 10% more or less penetration rate.
Yeah, which is not the case. Yeah.
Which is not the case. Okay.
Yeah.
Okay. And you would say the penetration rate is lower or higher?
It's probably low. Yeah.
And you would position it at what you think at the moment, even off the top of your head?
I can't give you a figure.
No, okay.
Yeah.
Because the interesting aspect of comparing Bitcoin to gold, as you said, it could be a means of exchange, a store of value. It's also interesting that when you consider how gold is produced, we more or less know the rate of production of gold every year.
Yeah.
Okay. In the case of Bitcoin, it's the same thing. We know the maximum number of Bitcoins that can be in circulation. And since what did they call it, halving of the amount that you get from mining Bitcoin, we can probably also determine a rate of progression of the number of Bitcoins in circulation. So there's a number of ways that you can compare Bitcoin to gold. The question will be whether over time Bitcoin can stabilize its value in the face of inflation, for example. And we usually see that when people have expectations of inflation, the price of gold goes up because it's perceived to be a haven from inflation. And what I had seen is that this was not yet the case for Bitcoin.
No, the comparison to gold is as a store of value. But yeah, you're right in the sense, like until and unless we can see kind of gold being replaced by Bitcoin in portfolios, we can't really say that this is the amount of penetration that it has got in the market. So yeah, the third model is the stock to flow model, which is a very highly debated model, and our purpose of including this was mainly as kind of a warning against it, because it has been kind of highly debated, and kind of a number of people have also disproved it. But it was created by an anonymous author, and it actually became very popular. And you could see, like, I don't know if people have seen it, but there's a rainbow graph which keeps going up, and basically it goes up to infinity, and which is obviously not possible. And yeah, so the ratio is calculated by dividing the stock of the resource by the amount of new production. So in Bitcoin's case, it would be the current circulating supply would be the stock, and then the newly mined Bitcoin would be the flow again. So as Olivia, you mentioned that you can kind of see how much is being produced in gold. You can use this model for any kind of commodity if you know the amount of production that's happening. And then so obviously there's a few limitations, a number of limitations to it. There's a lot of statistical errors. Autocorrelation does not mean Gauss Markov assumptions. And when you do account for that autocorrelation in the model, it becomes statistically insignificant. And then if you apply the same to gold, the stock to flow model to gold, the ratio is kind of ranges between 59 to 61 throughout its like lifetime, gold's lifetime. Even though the market cap of gold has ranged between like 60 billion to 9 trillion. So like it really doesn't tell you anything. And the main reason why we've put this in is kind of to inform people not to kind of rely on it. And again, we come back to Metcalfe's law. And as I mentioned that, some authors have found that the value of 1.69 is a better kind of number compared to the squaring of that number. Pele 2019 finds that there's a bidirectional causality between the price and network. So the increase in price will lead to more people joining the network, and then again kind of leads to price growth because more people are joining. So it kinds of a herding effect. And then we can also develop a ratio based on Metcalfe's law, which is the network to Metcalfe ratio. And we calculate that by dividing the log value of market cap by the log value of network value. So yeah, again, this is the same graph as earlier. We compare the market cap of Bitcoin to its 30-day moving average network value according to Metcalfe's law. And as you see recently, this is in 2024 mainly is because of the ETFs being approved and the recent price action. You can see it's gone way beyond the, when you consider the network value, it's gone way above that. And what I've seen is that from like 2021, the range of the number of active addresses on a daily basis has ranged between 400,000 to 500,000. But as you can see, like the price has gone kind of off of that. So the number of people who have been using it has been the same, but it obviously does not match with the price action right now. And then also one more thing I wanted to mention in this was that Metcalfe's law does not take into account the size of the transaction. So let's say that I spend maybe like 0.001 Bitcoin, I send it to someone, I would be considered an active address because I'm a sender. But on the same end, if let's say an institution is buying maybe 5 or 10 Bitcoin, that would also be counted as one active address, regardless of the size of the transaction. So that would obviously have a more impact on the price of Bitcoin. But this does not consider that, like, doesn't factor that into it. It's just based on the number of active addresses. And then finally, we have the cost of production model. So in this, we would consider, so developed by Adam Hayes, he considers it as a virtual commodity. And then going back to like economics, it's basically based on the fact that the marginal cost would equal marginal product, and if the marginal product goes below, the marginal cost, the miner would stop mining Bitcoin. And yeah, so we have a few variables in this: the price of Bitcoin, obviously, which we are going to find out. Then the difficulty is the amount of computational effort it takes to mine a block. The block reward is 6.25, which is, if you successfully validate a block, you get 6.25 Bitcoin in the reward. And then we have a time constant equal to 0.00002, which kind of considers the probability of successfully mining a hash, and times 24 hours, 365 days. And so we kind of have this time constant, which we apply later on. But and then finally we have the hashing power. So how much power is being used kind of to mine Bitcoin. So we have two equations: the marginal cost and the marginal product. And so we use an average price of 0.05 for electricity, and then times 24, because 24 hours in a day. And then we have the mining efficiency of the miner. So that's estimated to be around 0.028. And then 1,000 is the amount of the effort we're putting into the amount of power we are using to kind of mine that batch of Bitcoin. And so we get a marginal cost of 0.0336. We've just used 1,000 as just to simplify the equation over here. And then marginal product would be, again, the time constant times the block reward. And then we have the difficulty, which is 83 trillion. And then we get a marginal product, which is 0.00015. And then we get a price by dividing the marginal cost by marginal product, which is 22,000. So obviously it's very far off from the actual price of Bitcoin right now, and it's considered to be kind of the theoretical value at which the market price of Bitcoin may tend to gravitate around. Yeah, so it kind of explains the role of mining in Bitcoin, role of electricity in mining, and the economics of Bitcoin production, but obviously does not take into the factor that like it does not take into factor the original cost of buying the mining equipment and the maybe even the land that you're mining it on. It kind of only calculates based on the running cost or the operational costs of running a mine, and the daily expenses that you incur. Yeah, so we concluded by kind of realizing that there's no perfect valuation model right now, and which is fine, obviously, because the industry is still young, and I think discussion over these models will eventually lead to some kind of valuation model which everyone agrees on. Also, that we cannot use one single model to kind of value either of the assets. We would have to kind of like, for example, for Bitcoin, we could potentially use all three models, and then kind of consider a range of prices that we could potentially see of valuation. And that has been kind of the practice right now, which has been not relying on one model. We could use the mining production as the lowest possible value price of Bitcoin, and then kind of put in the total addressable market approach and um, the Metcalfe's law to kind of provide a range of potential value. We cannot use like one single model to kind of calculate that. And obviously the DCF models are sensitive to the assumptions, and even like exponential changes in any kind of the inputs leads to kind of big changes to the final value that we get. Yeah, and then obviously, as I mentioned, that disagreement over existing models should not be construed as a negative occurrence, and analysis and critique can obviously lead to the development of new and improved approaches, improving our understanding of crypto assets. And yeah, obviously, even though there are limitations to it, it's kind of a learning mechanism to understand more about crypto assets. Thank you. Yeah, any questions?
So yes, we would be happy to listen to any question you have, or if you have remarks, if you think this is completely off the mark, or even if you have approached evaluating difference between price and fundamental value, intrinsic value of crypto in different ways, for example. Obviously, the other conclusions that we've reached with all of those researches, it will take time for crypto or digital finance instruments to stabilize. What constitutes the stability, when it is stable, of financial assets, is also that it's time tested over time, and people can rely to an extent on some of those valuation methods to establish with some degree of certainty the difference between, again, price and value. And so the volatility of some of those instruments will need to stabilize over time. But we're very happy to listen to any question you have. Thank you very much, Urav.
Yes, thanks so much, Urav, and thank you so much, Olivier. Also, it seems no questions right now, at least. I think it was a lot of good information,
Yes.
and for all of us that wants to dig a bit further into the research and what the CFA Institute has done so far in the crypto world, maybe we could encourage people to look into the Research and Policy Center. Some great research there from Urav and Oliver and the team. So yeah, since we have no questions for now, I think it's maybe a good time to conclude and give people a few minutes back here in the evening. So with that, thank you so much again, Olivier and Urav, for presenting, and thanks so much for you to join in and listen.